Before we start with today's session, very interesting topic, what is the risk and reward ratio in your trading? Now, I would like to introduce our speaker for today. He's CY Saw Chuen Yen, well known as CY. He's a chartered market technician, CMT chartered holder. He's also a certified master trainer of NLP, and he's also a performance coach with extensive experience in coaching individuals with performance improvements, behavioral change, self-empowerment, and personal breakthroughs. Now, his specialty is in training system and strategies, training psychologies, NLP, and also coaching. He's the lead trainer for Excellent. Now, without further ado, please allow me to pass it over to you, CY.
Thank you, Ting Ting, for your introduction. Now, I would like to check and see whether can all of you is able to look at my slide and whether you are able to hear me clearly or not. So that along the way, when I have questions for you, you can actually type your answer in the chat box as well. So, hi everyone, how are you doing today? And I hope everything is doing well and fine for you on your side. So today's topic is about understanding the reward and risk in trading. So do you know what is your reward and risk in trading or not? And I believe today, some of you here have many years of experience in trading, and some of you have been trading for quite a couple of years already, and some of you are just beginners who are just just started your trading journey. So regardless of what background or trading experience that you come from, somewhere along the line in your trading journey, you will definitely encounter some challenges and questions like, how am I going to increase my reward in trading? How am I going to reduce my risk in trading? So you may heard of or learn about this reward and risk thing before, but just to keep an open mind anyway, because this topic, it can be very wide and it can be very, very in-depth. And you can see risk as well as reward from many different perspectives. And at the end of this session, you will understand that what are the important things in risk as well as the reward ratio, and you can relate it to your own trading strategies and how you can improve your trading strategies using this wonderful concept. All right, so let's get started. Now, a quick disclaimer here. Is for educational purposes only, for you to give you a quick understanding as well as to widen your horizon as well as exposure about knowledge in trading. You still need to study in depth as well as a little bit more in detail and develop trading strategies that actually suits you best. So here is just only a quick disclaimer where this presentation is provided for your educational purposes only. And I believe Ting Ting has already introduced me. My name is Chuen Yen. You can just call me CY. And now, before I enter into today's main topic, let me ask you these main three big questions that you need to address when it comes to trading. So you need to honestly ask yourself these questions. You can type in the chat box below if you know this question so that I know what is your understanding towards your own trading approach. The first question, is reward and risk important to you in your trading? So if you know the answer, you type in the chat box. And the second question would be, what is your reward to risk ratio in trading? Do you know your reward to risk ratio in trading or not? So hopefully you are able to answer this. If you cannot answer this yet, hopefully by the end of this session, you would have a clear idea and a bigger picture about how to find this reward to risk ratio. And the last as well as the third question would be, if you already know your reward to risk ratio in trading, are you able to achieve your risk to reward ratio in trading or not? Okay, a lot of people, I believe you may have heard or learned about this. but are you able to achieve the consistency in getting your reward in trading or not? Now, I see a lot of you. Question number one, most of the people would say yes. And oftentimes I will get response from most people is that, for majority, for question number two, majority, especially for beginner traders, they are unable to answer this. It's okay. Whereas for those who have learned trading before, right, you will be surprised that they still do not know how to answer what is their reward to risk ratio. While a very, very minority of traders and investors, they know their risk to reward ratio in trading clearly. However, when it comes to real life application, they are unable to achieve the trading results as indicated by the reward to risk ratio. They, after they go through a small short period of consecutive losses, and then, they just abandon their strategy and then they move on or try out something else new. Okay, so you may have experienced this before, don't worry. So this session, I will be focusing more on the concept of reward to risk ratio. Now, this webinar session will be organized in 4 topics I'm going to share with you. The first one would be the fundamentals of a reward to risk ratio. I will start with the basic foundation first so that all of us can have the same definition and understand the same language. And topic number 2, you will learn about the importance of measuring risk as well as reward in trading. So if you are unable to measure risk, then you are not able to measure your return as well. So it is important for you to be able to recognize your risk first before you decide what return you can expect to achieve from the market. Third topic would be the myth as well as the misconceptions behind reward to risk concept. This is very important as you need to understand about the reward to risk mechanism, how it actually works, and how do you actually get the winning as well as losing rate in terms of probability. And there are some magic numbers you need to understand in topic number 3. Okay, so in topic number 3, I will teach you how to actually get the magic number in terms of your reward to risk ratio. And lastly, we will go through a quick case study to understand how do we actually apply the reward to risk ratio in trading, what are the pros as well as what are the disadvantages in it. Now, let's get started with the first topic, the fundamentals of reward to risk ratio. There are some terminologies as well as words you need to know first so that all of us can have the same understanding in terms of definition and we are able to speak the same language. Now, when we come to understanding reward to risk ratio, of course, there are just 2 keywords, which is the reward as well as the risk. So both reward and risk, both of them actually comes from the price changes, the fluctuation in price. So if you're in the right direction, you definitely make money. So this is actually your reward. Whereas for the risk is when you are in the wrong direction and you lose money. So this is your risk. So both of them are actually referring to the price changes. If you are correct in the right direction, yeah, you make money. If you're in the wrong direction, you lose money. So those are your risk. And of course, when it comes to trading, investing, or even in doing business, your reward must be definitely be higher than your risk, correct? And when it comes to trading, a commonly used reward to risk ratio would be 2 to 1. Okay, so the risk would be always labeled as 1, and your reward would need to be larger or more than 1. Okay, so the concept here is very simple. Your reward, when it comes to investing and even in trading, your reward must be greater than your risk. Now, similarly, when it comes to reward to risk ratio throughout the internet, articles, website, or even books, you may come to these 2 interchangeable terms. The first one would be reward to risk ratio, where how you are going to read this is that you see the first word is reward, right? So reward would be, of course, would be, labeled here at the front first, and the risk would be always labeled as one, which is putting behind. So what does this actually mean is that for every $1 that you risk, you expect to make $2. So this is a reward to risk ratio of 2 to 1. And in other words, if you want to risk $10, which is 1 times your risk, then you will be expecting to make 2 times of a reward, which is $20. Another interchangeable term that you would commonly use is actually the risk to reward ratio. So both of them are actually opposite, but it actually refers to the same thing. So all you need to understand is that the reward would definitely have to be bigger than the risk. Okay. Both of these terms, we will be using it interchangeably, and all you need to understand that the reward has to be bigger than the risk. Now, when it comes to understanding reward to risk ratio, you need to understanding what are the expectations in trading. And let me know, what is your expectation when it comes to trading? So let's say, for example, when you sit in front of the computer looking at quotes, trading quotes, what do you expect when it comes to trading? So regardless of whether you are currently having a position in the market or you don't have position in the market, it's okay as well. What would be your expectation when it comes to trading? So when we mentioned about expectation, I give you some clues here. You can expect that the market can be bull or the market can be bear. You can expect the market to be strong or even weak. You can be feeling positive about the market or negative about the market due to political issues, war, or any other crisis. Or maybe your expectation from trading can be very simple only. It's either you want to make money or you lose money in this particular trade. Or maybe some other expectations that you have in trading. So do share what would be your opinion, what is your expectations in trading. Let me know what would a general trader would actually think when it comes to trading. So I can see a lot of you would actually type profit as well as making money, bull market. So for a majority of the people would actually, the first thing when it comes to expectation, when it comes to trading, is definitely looking at the bright side first, right? Making money. Okay. So let's temporarily set this aside first, and later we will revisit this concept again. Okay. Now, when it comes to expectation, there are two keywords, two main words that you need to understand, which is expectation as well as a reality. So what does expectation actually means is that it is something that is in your mind. You are just thinking about it only, and you wish for it to be happen, or something that you wish for it not to happen. So in other words, expectation is something that it is not the fact that it haven't really happened in the market. So all of these happenings, it is just only in your mind. Whereas for reality, it is something that has already happened in the market. Everybody knows it. It is appearing in the news already. So of course, when we compare the difference between expectation and reality, so if your reality is very, very significantly different from your expectation, so this is where, a lot of emotions will actually comes in that forms your trading psychology. Now, when it comes to expectation, what is your expectation in trading? A lot of people, when it comes to trading, what they expect is that, as they trade, the more that they trade or along the way, they hope or expect that the profit or the result that they get from trading is actually a moving upwards, a straight line. So in other words, they think that, each and every time that they trade has to be making money, it has to be profitable. So in other words, the logic here is that the more you trade, the more profit that you are going to make. But in reality, it is not true, because it is really, really hard to achieve from trading. So how would actually the reality would look like? It would be looking something like this. Can you see that? It would be a zigzag path as you trade, and it's along the way, after 10 years or maybe 20 years, you will still achieve the same or reach the same destination. It is just that along the way as you trade, it is not a definite straight line, because along the way, you may be facing some losses here or there. It can be minor losses, it can be a huge losses, or it can be, the market is just not moving anywhere. It is just a stagnant market. So I do take note on this. The reality of the market is that when it comes to trading, losses are just part of trading. So it is very, very important that you acknowledge losses is just only part of trading, and you need to be comfortable with losses. So if you want to do trading, you need to be able to accept this reality. So today's topic, we will be looking at different perspective of expectations, but today we will be looking at one specific expectation only. So when it comes to expectation, there are several types of expectation, right? So some of it you heard about it already, whereas some of it it can be very new to you. So one of the expectation would be mathematical expectation. The other expectation is that you can use I believe some of you learn technical analysis, right? So you may use the knowledge that you have to make an expectation about the market. Maybe you draw trend line, support and resistance line, or maybe using some unique or special indicator to look at the market. Some of you may be using fundamental analysis to look at what is happening in the economy and how does actually inflation affects the market, for example. And last of the expectation would be the market sentiment. So these would be the four main categories of expectations. Of course, there are still a lot of areas of expectation that we can actually explore, and these are actually the four major ones. So today we will be mainly looking at mathematical expectation. Okay, so I will not be going in so much on technical analysis or even fundamental analysis. We would be focusing more on the mathematical perspective in terms of trading. And now let's go into topic number 2. So now that you have already learned what is risk, what is reward, and what is expectation as well as a reality. Now the question for you are you able to measure risk, and how do you actually measure a return in trading? So this is a important thing for you, so that you are able to recognize risk first before you decide what return you can expect from the market. Okay, now let's look at this picture. What information can you get from this particular picture on your left? You can type in on the chat box below. As you look at this picture, what information that you can get from this picture? Well, some of you maybe say traffic lights. Some of you may say, a human walking. There would be a road. There would be a zebra crossing. You would want to crossing the road, right? So as you look at this picture, it is a very common analogy that we do in our daily lives, right? As long as you get out from your house, you definitely have to every day practice this thing, almost every day at least. I do not know how many times, maybe 10 times, 20 times, or even more in a particular day, regardless of especially when you need to cross the road. So a general rule of thumb of crossing the road, do you know what is the general rule of thumb in crossing the road or not? Let me test you on this. It's a very simple concept. It is only a three-phase thing only, where when you teach your kids, or when we are young and small, we always learn the thing that you need to look right, look left, and then look right again. Correct? So that why do we need to look at right 2 times? That is because you don't miss anything out on the right hand side. So the similar general rule of thumb, this commonly practiced in daily life, you can use this in terms of your trading as well. So when it comes to trading, most people just only look at how much to make. When they look at green light, they just walk across the green light. They don't look at right, left, and look right again. So a good common practice is actually it's about safety. It's about you reaching your destination. It's about you reaching your trading goals. So same thing when it comes to trading, you need to look at risk first, and then look at reward, and look at the risk again. Okay, so here we can see that we need to look at risk 2 times. Okay, not reward first. So I understand a lot of people would ask that, why don't we look at reward first, look at risk, and then look at reward another time? And it would be a general and common rule that if you look and read through among those successful investors and traders biography, most of the time they will mention about managing risk, protecting their wealth, their money first. So which is a very, very important practice, is that you need to look at risk 2 times more than reward. Now, however, when it comes to trading, a lot of people just look at one side only. So let's look at what happens if you just look at reward only. Now, many of you who comes to trading, right, of course, definitely with the intention of making money. Am I right? Me too as well. And of course, otherwise, why do we even trade in the first place, right? But the challenge here is that if you are just only looking at the rewards, it can bring a lot of disaster to you in trading at the very later stage. What are the disaster that it will come to you would be this. So when it comes to trading, a lot of people look at how much to make, and they don't look at the risk at all. They will be starting to ignoring risk, and they may be very aggressive in their trade already. So they might be thinking, instead of making money at a slow pace, why not I make money at a faster pace? And that is where you may begin to be very, very overconfident. You can be very gung ho and all in. So this is where you will be trading too big size, taking too huge position, or even over trading by trading too much, thinking that the more frequency that you trade, the more money you make. Correct? So this may be something that is very related to you, or maybe it's happening to you before already. So with this thing that is happening in the market, so ultimately, if you just look at risk, there would be high chances for you to blow up your trading account. So of course, in a good and strong market, everybody is making money. But when the market changes its direction, many people give their profits back to the market and are making losses as well. Now, how about when you are just looking at risk only? Okay, maybe you are this category of people where you just only look at risk only. You are, you know that there is reward, but constantly you are just looking at the risk only. So this is where it may leads you to thinking too much about the market, overthinking. You analyze too much, and it paralyzes you to not being able to make a good trading decision. So it discourages you because all you think, all that is happening in your mind is that at the negative side, or what if bad things happen to me in the market. So this creates a lot of anxiety, and ultimately what happens is that you do not make any decision and you don't execute your trade. So this is where, even if your analysis is correct, you may miss the trend completely. Okay, so in short, you can't just only looking at the reward, and you also can't just looking at the risk. You need to look at both sides. Just like how you cross the road, look at risk first, look at reward, and then look at risk again, to see whether it makes sense or worthwhile for you to take the risk to make the necessary reward. Okay, otherwise don't take any necessary risk. Now, before we go to topic number 3, let's go through a quick simple exercise game first. Now, of course, this game would be very, very simple. I believe a lot of you understand this. It's a game that has a 50-50 chance of 50% of chance winning, 50% of chance of losing. Okay, so you can choose either head or tails. If you are correct, you win and you make money. If you are wrong, you lose and you lose money. Now, let's assume we are going to play 100 rounds for this game. Now, I'm going to give you 3 types of game for you here, and let me know which of these game that you would choose. Game A is that if you win, you make $10, and if you lose $10. Very fair, right? Game B, if you win, if you're correct, you make $8, and if you're wrong, you lose $10. And game C, if you win, you make $12, and if you're wrong, you lose $10. Now, type in the chat box below which of these game that you would definitely play. Which of these game you would choose to play? So a lot of you choose C, right? So it's very common sense and logic, right? Because what you make is actually ultimately generally bigger than your losses. So even at a 50-50 chance of game, right, as long as the payoff, right, your reward is greater than your risk, you can actually play this game. Now, if we were to put it in another words, game A would be something like you move 3 steps forward, and when you are wrong, you move 3 steps back. So ultimately, you are remaining static. You're not going and you're not moving forward, correct? Game B would be something like you move 3 steps forward, and when you are wrong, you move 4 steps backward. So ultimately, if you play throughout 100 games, you may be actually moving backwards instead of moving forwards. Whereas for game C, when you are correct, you move 3 steps forward, and when you are wrong, you move 2 steps back. And ultimately, you can see that you are actually walking forward and walking ahead of others. Now, let's go through another scenario. Scenario number 2. Same game, 50% chance. We are going to play 100 rounds as well. So there are 3 games for you to choose. Which of these games that you are going to choose to play? Game A, if you are correct, you make $10. If you're wrong, you lose $10. Game B, if you're correct, you make $10. If you're wrong, you lose $8. And game C, if you're correct, you make $10. And if you're wrong, you lose $12. So which of these 3 games would you choose? You can type in the chat box below which of these games that you definitely play. So all of you put in B, right? So of course, for all of the game that has the same winning, right, it would be making sense for you to choose a game that has the lowest risk, where your reward is actually greater than your risk. So all of you passed already. Scenario 1 and scenario 2 is easy for you to understand. Now, let's go to later on, we go to scenario number 3. So now that you have already known risk and return is actually, the payoff itself is very, very important. So what do you learn from these 2 games is that just by understanding the ultimate payoff, even though the game is 50% chance only, when you understand the ultimate payoff of the game over the long run, eventually you will know which of this game it is actually worthwhile to play. So knowing what is the ultimate payoff over the long run, you will have a net winning after many, many rounds. Okay, so this is a very important concept that you need to learn by heart. Now, topic number 3. This topic is very important. You need to understand how does the risk and reward mechanism works. And there are some calculations here, but don't worry about it. You just need to understand the general concept of how it actually works. And there are some formulas to get the magic numbers you need to understand too. Now, as you know, this guy, George Soros, is actually one of the greatest speculator of all time. And one of the quote that he mentioned is that it is not whether you are right or wrong that is important, but how much money you make when you are correct and how much money you lose when you are wrong. So what does this guy actually trying to imply? So very simply speaking is that, what he is trying to say is actually very simple, yet it is very, very profound. And he is actually referring to the reward as well as the risk concept. So let's go through the mathematical part on it, on how do you actually derive your risk to reward to risk ratio. And on the mathematical expectation, a general reward to risk ratio is 2 to 1. It can be, your reward 3 times, risk is 1 times, your reward 4 times, your risk is 1 time. So let's go through a general one, commonly used, which is 2 times return and 1 time risk. So what does this mean is that, for example, if your 1 time risk is that you are willing to risk $500 in a particular trade, so your expectation for return would be 2 times of your risk, right? So 500 times 2 would be 1,000 profit. So far, can follow me? And when it comes to trading, so a general thing would looking something like this. For example, when you expect the market is going to go up, you are bullish about the market. So you place a long position or you buy the market. And this is where the risk that you set that is $500. So if your losses is more than $500, you cut your losses short, you get out of the market. If your losses is not haven't touched $500 yet, you just leave your position there. And your reward is that you aim for 2 times reward, which is $1,000 of profit. Okay, if you're using reward to risk ratio. So what does this mean is that your expectation of a 2 to 1 reward to risk ratio, this is actually for every single trade. Now, I believe majority of you learned this concept before, you heard of this concept before, right? And this concept seems very easy, correct? And it's definitely an ideal concept to apply in trading. And most people only apply this for individual single trades only. Okay, and they don't look at the long run multiple trades, because ultimately your trading would be, you want to do multiple trades, right? You want to do trading 10 years, 20 years down the road. You are actually not doing, put your money in and then wake up 10, 20 years later and expect to see what is your return from your trading, right? So how do we actually make this work is that it's very simple. Are you able to apply this in your trading every single time or not? And in fact, in reality, a lot of people would have already given up half the way. Why? It's because when they start losing money a few times, and that is where they give up and they just call it quick. They abandon this concept in trading, or they may even abandon the trading strategies or the trading system that they use. Okay, does it sound familiar to you already? So if you are trading in the market quite some time already, maybe this is something that you have practicing in the past before. So if this is concept applies to a single trade, can we actually apply this in the long run multiple trades or not? So this is where we would want to look at what is your expectation over a long run when it comes to across multiple trades. Now, here there is two keywords, which is long run and multiple trades. Okay. Now, based on your reward to risk ratio, do you know what is the minimum winning probability that you need in terms of making money or not? So I believe a lot of speakers or trainers, or even in YouTube, you might heard a lot of people talking about reward to risk, high probability, low probability, right? But they don't come up with an exact number of probability in terms of percentage. So later I'm going to share with you how to get those magic numbers. Now, there are many types of reward to risk. It can be 1 to 1, 1.5 to 1, 2 to 1 is something that we have already discussed. It can be 3 to 1, 4 to 1, or even 10 to 1. So do you know that what is the winning probability you need in order to capture the reward to risk or not? So a lot of people, they know their reward to risk, but they somehow ignore the winning probability part. And having a risk reward to risk ratio alone is not enough. Okay, you also need to look at both the winning as well as the losing probability as well. Okay, I repeat again. If you know reward to risk ratio, this one concept itself is not enough. You need to also looking at the probability, the winning probability as well as the losing probability. And where does this probability comes from? It actually comes from your trading strategies and system. So once you understand this concept clearly, your mindset about trading would be very different. You would see trading very differently as compared to others in the market. Okay, so later on, I'm going to share with you some of the mathematical workings on how do we actually derive the probability. Now let's go through a very simple equation first. Now, when it comes to long run expected return, right? So the return that you expect to get from market is of course positive, right? And this is where you want to look at what is your profit trade, the profit that you make, as well as minus out the losses that you make in your trading. So this is on a few trades only. When it comes to multiple trades, it would be, you lump up summarize all of your winning trades together, as well as you summarize up all of your losing trades together. Your winning trades have to be, how much you make from winning trades has to definitely be more than your losing trades. And if we were to go down even more detail, it is where not only understanding winning trades is not enough. Okay, you also need to know what is your probability of winning and how much you are making when you are right in a particular trade, and how much you lose in a trade and what are their losing probabilities. Okay, so we are going to go through this in a short while. Bear with me a while. You need to understand a few keywords first before we come back to this. Okay, now the first thing, which is you need to understand what is the winning as well as losing probability. So on the left hand side, this table is let's say it's across 10 trades. Of course, when you trade, you may have 50 trades, 100 trades, 200 trades, 500 trades down the road, and not every single trade is actually making money. There will be times you make money, sometimes you make a lot, sometimes you make very little, and of course there will be times you lose money. Not only you lose money, you will be losing consecutively for 3 times, 4 times, sometimes depending on your strategy, it can be losing 10 times in a row. Now, from this table, we can see that there are 4 winning trades and 6 losing trades. So how do we translate this into winning probability? So winning probability in other terms, we also call it winning rate, right? So 4 winning trades out of 10 trades here. So this is where you lose, you use 4 divided by 10. And this is where you have 40% of winning trades. Your winning rate is 40%. And your losing rate would be 6 losing trades out of 10 trades. So 6 divided by 10 here would be 60% of losing rate. Okay, can follow so far? Now that you have already learned all those terms, right? Now we slowly progress it to in terms of real calculation. So if we were to look at individual trade, for example, a reward to risk ratio of 2 to 1. 2 is actually, for example, if you would want to risk $100, so what you expect to make is actually $200, right? So in net, you would actually make $100 in this particular trade if you were to do this many times. However, if we were to look at multiple trades, you can apply the same formula as well, where your profit minus your loss. Profit is where you get all from your multiple winning trades as well as your losing trades. So here we lump up together our winning trades minus out our losing trades. So here in this equation, we can see that our losing trades, we lose more than we win, right? But in total, you can realize that ultimately you are actually having a net positive, a net return, and making profit from the market. So from trading, here is that it's okay to have frequent losses. What is more important for you is that you need to keep your losses small. Okay, the formula for making consistent profit in trading is that it is not because of having a lot of losses. It's okay to have a lot of losses. The formula for winning over the long run is that you need to keep your losses small. For example, like this case. Okay. Now let's go into a little bit more technical part of how to get your percentage. So here we have profit minus loss, winning trades minus losing trades, and now we can look at your winning probability as well as your losing probability. Now, in terms of profit, here our profit is actually our reward. So again, in this example, we use a 2 to 1 of reward to risk ratio, where your reward is actually 200, and your risk is actually 100. Now, we would want to find what is the winning probability as well as the losing probability, so that you can know what is the minimum winning probability for you in terms of making money over the long run. Okay, now pay attention to this. In this formula, we simplify it, and now you need to find what is W. So if you see this, this mathematics might be difficult, but it's okay, because later on, next slide, I'm going to give you a simple calculation. So now I'm actually giving you a simple mathematical proof of how to get the numbers for winning rate. So let's say you want to find 0. So on the left hand side, let's say you put your expected return is 0, equals to your winning probability times your profit, and your 1 minus W, which is 1 minus your winning rate, times 100, which is your losses. And I believe you have gone through your high school, right? Your simultaneous equation mathematics. So here, 200 times W, you get 200 W. And for this one, you move it over, you get 100 minus 100 W, and you simplify it, you can get 100 plus 100 W, and you simplify it further from the left and right hand side would be 300 W minus 100, and you move your 300 over here, and then here, this is where you can find your W, and you take your 300, move over to the right hand side. So this is where 100 divide by 300. So this is where you get 33% of break even for a winning probability. So if this seems sophisticated for you, don't worry. Later on, I'm giving you a simple formula to understand. So this is actually a mathematical proof. How do you get the magic numbers of a winning rate? So here for a risk reward to risk ratio of 2 to 1, simply speaking, is that if 33% is a break even, all you need is that as long as your trading strategy has more than 33%, eventually you will definitely make money from the market. Okay. Now, here is 33%. So later on, we are going to use a simple formula for you to derive how to get the magic number. It's very simple. Same thing. We want to find out what is the winning probability. So this is where you need to find W. It's now you can actually jot down what is this formula. It's very simple. You use 1 divided by your reward plus your risk. Okay, so we are using a reward of and risk of 2 to 1. So you use 1 divided by your reward plus your risk. So 1 divided by 2 plus 1, ultimately it will be 1 divided by 3. So same thing, the answer you can get is 33%. So the interpretation is the same. For a 2 to 1 reward to risk ratio, you need to have more than 33% of winning rate in order to make money. Okay, now let's use this simple formula to apply into finding our magic number. What would be the winning probability you need in order to make money from trading? Now, the first one, for a reward to risk ratio of 1 to 1, what is your winning probability for you in terms of breaking even? So very simple, 1 divided by your return plus your risk. So it's 1 divided 1 plus 1. So it is 1 divided by 2, right? So it is very simple, 50-50. For a reward to risk ratio 1.5 to 1, you need a minimum 40% of winning rate in terms of breaking even. 2 to 1, we have already gone through. You need 33% to break even. How about reward to risk ratio 3 to 1, 35%, and reward to risk ratio 4 to 1, you need 20%. So what can we derive from all of these magic number here? Here, can you see that, as your reward, your risk remains the same, right? It's always not 1, it is constant. Whereas as your reward keep increasing, right? All you need is actually, you need lower probability in terms of breaking even, okay? So the implication here is very simple. High winning probability trade, usually it comes with a lower reward, okay? Strategies that have high probability, the reward is low, and strategy that is having a very, very high winning, very high reward, right? The probability that it actually comes with it is actually very low. Okay, so you need to understand this reward to risk concept as well as their winning and losing rate in terms of selecting your trading system. So you need to be comfortable with the numbers here first, because there would be a good and bad trade-off. Because if you want to get a high return, do expect that your trading strategy has low winning probabilities. Okay, and if you want to have a strategy that has high winning probability, your reward would be low. Okay, now let's go into the last topic, which is our case study. How there are challenges for you when it comes to reward to risk in trading, because when it comes to application, this concept would be a little bit hard to apply if you just look at individual trades. Okay, individual trades, if there are times it can be very tuned, very accurate, but there are times it does not work at all. So the reward to risk concept, it is more relevant and more applicable in terms of looking at multiple trades over the long run. Now, let's look at this particular chart. It's an FCPO chart. So let's look at this on the left hand side. So for example, if you look at you draw a resistance line here. So on this particular day, right, you see that, oh, there's a breakout resistance already. You would want to take a long position. You want to long the market. So you set a reward to risk ratio of 2 to 1. And how much you are going to risk for one time risk is that you risk 100 points. So your return would be 2 times of your risk. That would be 200 points. Now, so as the time pass, you can see that, okay, you are right in this particular trade, you make money and your profit target has already achieved. So this is where you take your profit. And then what happens next is that, the market goes on even further up. The trend continues even further up. So this is where you may be missing a bigger opportunity, right? So here you can see that although you set your reward to risk 2 to 1, sometimes the market give you even more reward now, So in a general perspective, so let's be realistic a little bit. Here you may be missing 500 points here. Why 500 points? Because I am actually using this point here to, let's say you exit your trade at this particular red candle, because in trading we are unable to pick or exit at the immediate top or the peak level, right? So let's take a realistic area here where if you were to use exit at this particular place, you would have an additional of 500 points. So in total, the market is actually giving you 500 plus 200 points. It's total 700 points against your one time of your risk. So your market is giving you 7 times reward for your 1 unit of risk that you take. So this is one of the challenge where a lot of traders would face when you use this concept, is where your actual profit may be bigger or exceed your expected profit, right? So how many of you actually face this issue in your trading? You can type in I in me, or type in I in the chat box below, because I believe that when you do learn about reward to risk, right, you are just learning a very simple, small aspect to it. So today I'm giving you a little bit broader aspect and looking at how does this reward to risk applicable into a bigger picture as well as multiple trades in your trading. Now, question for you is that if you do 2-to-1 trade here, are you actually having a good trade or having a bad trade? Okay, I know a lot of you may have missed this, but my question for you is that, is this a good trade or is this a bad trade? Most people would say that, if they miss 500 points behind, they would say it's a bad trade because they should have taken that 500 points instead. But in fact, this, if you were to follow your reward to risk 2-to-1, this is actually considered as a good trade. You are doing correctly. Okay, it is not just so-so trade, it is a very, very good trade if you are able to continue to do the same thing over again and again. Now, let's look at the second challenge in applying reward to risk. So for example, at this particular point, you see that there is a new high. So you enter long at 3,000 points. So same thing, you'll set 100 points as your risk. If exceeding 100 points, you cut your losses. If it reached 200 points, you take a profit. So as time reviews, you can see that, there will be, time you see that you have profit, you are, quite impatient that you want to take a profit, right? But you tell yourself you want to, follow your trading discipline as strictly as possible because it haven't reached a profit target yet. Somehow or other, it haven't reaches your reward. So this is where, your profit is just only reaching about 1.8 times or 1.9 times. And then later on, it turns negative. So this is the point where, the market turns have a U-turn and you have to cut loss. Now, the question to you is that, is this a good trade or is this a bad trade? Most of the people would, if you understand this concept very well, you would definitely would say it is a good trade if you are able to do this consistently. However, if you don't understand this concept well, a lot of people would say, as long as you initially got profit, how come it becomes cut loss? Then, sooner or later, they begin to, abandon this concept or they change other strategy already, okay? In fact, this is actually a good trade. If you stick to your trading approach and if you have the right trading discipline to follow through it. So most people are unable to stick with their strategy because of just only a few misses and they just abandon their strategy already because they don't understand their strategy thoroughly and they don't understand the reward to risk in their trading strategy. Okay, even if you have trading strategy, it's not good enough. It would be even better if you know the reward to risk of your trading strategy that you use over the long run. Okay, so challenge number 2 is that your expected profit is about to achieve, but you ended up losing money. The last one, which is also a challenge. So here is a FKLI chart where you can see on the right hand side, there would be an opportunity for you to enter long. So you enter long at 1,610. So you set your risk to reward again 2-to-1 times. 20%, 20 points risk, one-time risk, and then your 2 times return would be 40 points. So let's look what happens next is that, in a 2 days or in a few days, your cut loss level has been hit. So it hits your cut loss level, more than 20 points, you cut your losses, you get out. However, the next day, the market rebound a little bit, and then, the market continues its trend. So it's quite frustrating a little bit. So this is, again, another challenge for a lot of people when they want to apply reward to risk ratio because you are just only looking at individual trades only. Okay, but if you look at multiple trades, for example, 50 trades, 100 trades down the road, your reward to risk in trading is actually workable. Okay, so this is the third challenge where your expected losses hits and then the trend continues. So these are the 3 big challenges that you face when you apply this concept in your trading. The most important part is that you need to understand what are their advantages as well as their disadvantages. So the advantages is that you definitely know what are your losses. You can limit your losses small and manage your losses, especially when your losses is being hit. You can get out with a good losses, small losses, without any hesitation. And it gives you a different perspective at looking at the ultimate payoff in terms of trading. However, the disadvantages would be that, as we have already gone through the case study, the three challenges would be it limits your profit potential, because one of the basic rule of trading is that let your profit runs, right? So if you use reward to risk ratio, how are you going to let your profit run? That would be a separate different topic already. Okay, you need to look at what is your reward to risk ratio for your particular trading strategy, because different trading strategies, their long run risk to reward ratio is actually different. And even if you're in the correct direction, you may be cut loss and get out too soon from the market. And this, the traditional reward to risk ratio, right, it actually misses out probability. So today I share with you this concept. We have already added probability back into risk to reward ratio, so that you have a bigger perspective, a comprehensive understanding of how this whole thing actually works. So you may be asking me what is the suggested reward to risk ratio, right? Whether 2 to 1 time is better, 3 to 1 time better, or 4 to 1 time is better. In fact, everyone, I believe, I believe all of you here who is listening to this webinar, we come from different age, we have different expected lifestyle, our goals and objective in trading will be different. Risk as well as tolerance is different. So I don't have a hard answer for you in that. All you need to do is that you need to find a trading approach with a risk reward profile that actually suits you. So what does this mean is that you need to understand your trading strategies and your trading system thoroughly. Don't just copy and paste other people's strategy or blindly follow without any understanding. And in your trading strategies and system, you need to also find out what is their own reward to risk ratio, as well as the winning and losing rate. Okay, so as you have already seen the magic number already, it's okay to have a low winning rate, but you need to make sure that your winning payoff is high enough to cover all of your minor losses. Or in other words, if you want to have a big winning, make sure that you are comfortable with the low winning rate. Okay, and if you want to go for a high winning rate strategy, you also need to accept that the performance as well as the result may not be ideal or fantastic for you. Okay, so that's it for today. The 4 key takeaway points for you is that I've already covered the basic concepts of reward and risk. You also understand what is the importance of measuring your rewards as well as your risk. So the general rule in terms of looking at trading is that you need to look at risk at least 2 times. Always look at risk first, and then look at whether the reward justify the risk that you take, and then look at the risk first, whether you're okay or comfortable with the risk. You also need to look at what are the ultimate payoffs and the probability. And of course, the misconception in terms of reward to risk is that it only focuses on individual trades, and most of the people, when they apply this concept, they limit their winnings. Okay, so in fact, the purpose of reward to risk is to find out what is the probability of winning and losing, and how are you going to limit your risk. Okay, always stick to the rule of trading where let your profit run. So don't always limit your losses. Okay, you can limit your winning, you can limit your losses, but never ever limit your winnings. Most people they are unable to follow this concept is because once they lose their have a short-term loss, right, they immediately abandon their trading strategy because they don't understand the concept of reward and risk. And lastly, do always backtest your trading strategy. Test your trading strategy, whether your trading strategy works in the past or not. So this is where you can do paper trade if you have past historical data to see whether your strategy works or not. You can also look at the reward to risk. So from there, you can roughly have a feel whether this particular trading strategy suits your personality as well as your risk appetite. So that's it for today. When it comes to trading psychology is very, very important because trading psychology is not just only about emotions, right? It is also about the concept, the knowledge that you learn. If you have the right concept, you may or may not apply it correctly. But if you have the wrong concept, when you learn the wrong concept, there would be very, very low chances for you to apply it correctly. Okay, so that's it for today. I'll pass this back to Ting Ting.